Welcome back to the channel. My name is Derek Coffey and I'm the founder of FWP. And one of the most important pieces of financial planning is understanding why you're doing what you're doing with your money, understanding the mechanics behind the moves that you're making. You can go anywhere on the internet and find a soundbite or a 30-second clip of financial advice that you might be able to implement into your plan. But if it doesn't fit, then you could be setting yourself up for failure. Roth conversions are no different. Last week, I put out a video going over a 65-year-old couple with $1 million in their 401ks, and I showed you how Roth conversions could save them well over $100,000 in taxes in their retirements. One of the things that I failed to do in that video is get into the specifics of those Roth conversions to show you how it actually works. So in this video, I'm going to fix that. We're going to get into those mechanics. We're going to get into those finer details of a Roth conversion. That way you can understand what's going on with your money and why it's happening. Once you understand how Roth conversions work, that's how you can ensure that they're going to fit your plan. Stay tuned. Before we go any further in the video, there are two disclaimers that I want to give you. The first of which is I'm not a licensed tax professional. All of the information that's in this video is meant for informational, educational purposes only, and if you decide to make any changes to your money based on taxes, I would urge you to do so with an accountant. Disclaimer number two is that this video is meant specifically for retirees that are receiving Social Security. I don't want to waste your time if you're not receiving Social Security because your tax situation is going to look completely different. So if you are receiving Social Security, this video is for you. But if you're not, don't worry, because in the near future, I'll be doing videos on conversions for those that are younger than 62. So the point of doing a Roth conversion is to avoid or eliminate taxes. If you have money saved in a pre-tax account, at some point, you're going to have a tax bill. If you're in a position that you can live off of Social Security alone, that's awesome. But at some point, the government's going to force you to take any money that you have in a pre-tax account out. This is known as a required minimum distribution, and if you were born in 1960 or later, when you hit age 75, you're going to be forced to take out a certain percentage of your pre-tax accounts. If you are looking to avoid this and the associated tax bill that comes with it, then a Roth conversion could help. Now, the second type of tax that we're looking to avoid with the conversion is the taxes that your beneficiaries are going to pay when they inherit your pre-tax money. If your beneficiaries are anyone other than your spouse, then they're going to have 10 years to liquidate that pre-tax account. All of the money that they receive from that pre-tax account is going to go right on top of the income that they currently earn. If they're earning enough money to fill up maybe the 12% tax bracket, then all of the money they have to take out of the pre-tax account they inherited is going to be taxed at 22%. So if you would like to avoid these taxes, whether while you're alive or when your money passes on, then a Roth conversion could help. So the reason that I decided to break this out into its own video is because if you're receiving Social Security, doing Roth conversions makes your tax situation even more complicated. And the reason this is because there are two calculations that have to be done to figure out how much income tax you're going to owe when you are receiving Social Security. The first calculation that has to be done is your combined income or your provisional income calculation. The way they come up with this income is they take your taxable income, add to it your tax-exempt interest plus 1/2 of your Social Security benefit. The reason that they do this calculation is because it's going to determine how much of your benefit could be subject to income taxes. Also, if you weren't aware, up to 85% of your Social Security benefit could be taxable income, depending on how much income you report. So if you're in a situation where you can live just on Social Security and you're receiving $48,000 a year from the Social Security Administration, then you're not going to owe any taxes. Because you don't have any taxable income, you don't have any tax-exempt interest, your combined income is $24,000. When you take that figure and compare it to the thresholds of determining how much of your benefit could be taxed, it doesn't go past that first threshold. Any of your combined income from $0 to $32,000, none of that is going to count towards your taxable Social Security. 50% of anything from $32,000 to $44,000 is going to count, and then 85% of any of your combined income over $44,000 is going to be subject to income taxes. Now, if all of that adds up to more than 85% of your Social Security benefit, then the maximum amount of your benefit that could be subject to taxes is that 85% amount. So we got all of that out of the way. What happens when we start adding income to this picture? Well, just for reference, you could, if you're married, add $22,000 of taxable income to that $48,000 of Social Security income and still pay zero taxes, at least federally, on the money that you received. So we take the 22,000, we add to it one half of the benefit, which is 24,000. That gives us a combined income of $46,000. We compare it to the thresholds, and because of that, $7,700 of your Social Security benefit could be subject to taxes. So we take that number, add it to the taxable income that you received, or that $22,000, and your adjusted gross income is going to be $29,700. If you and your spouse are under the age of 65, your standard deduction in 2025 is $30,000. We take that away from your AGI, and that leaves you a taxable income of nothing. Now, to have this broken down into something that you can understand and that's a little bit slower, I'll link that video somewhere up here. And you can watch that all the way through. It's only 8.5 minutes long, but it breaks down how you can receive $70,000 a year of income and not pay any income taxes on it. Now, the reason that we needed to know those calculations is because that's what's going to help you determine how much money you can convert in a calendar year. So the first thing we need to understand are the tax brackets. And in 2025, if you are married filing jointly, any of your taxable income over zero up to $23,850 is going to be subject to 10% in income taxes. Anything from $23,851 to $96,950, you're going to owe 12% in income taxes. And the reason that you need to be aware of this is because those are the upper limits of the tax brackets that you're looking to fill. So how do you know how far you need to fill? Well, if you project out your numbers and you figure out that your RMDs are going to cause you to pay 20% in income taxes, then it's going to make sense to convert at a lower tax bracket, or in this case, 12%. Now, the reason I'm not going to go beyond 12% is because my content isn't meant for people that have seen the 22, 24% tax brackets. It's meant for the people that have been in the lower tax brackets most of their life. But what we're looking to do is avoid that major tax surprise due to those RMDs. So now that we understand all of the mechanics and the behind the scenes stuff that's going on with Roth conversions, we can actually put a number on how much you could convert. So let's say you are married. Let's say you are receiving $48,000 from Social Security. Then you have a lot of room in those tax brackets to convert your pre-tax money to a Roth. With the $48,000, you don't have an adjusted gross income. You don't have a taxable income. So what we're going to do is we're going to try to get that taxable income box up to the $23,850. Now, I could go back and forth on what numbers are going to be the right ones, and I could waste plenty of time. But instead of doing that, I already have the answers for you. If we were to take $35,050 of your pre-tax money and convert it into a Roth, we're going to fill up that 10% tax bracket. Our adjusted gross income, based on the provisional income calculations, is going to be $53,842. We have $18,792 of Social Security benefit that's taxable, as well as the $35,000 of the conversion. We take away the $30,000 of standard deduction for anyone under the age of 65. That leaves us with a taxable income of $23,842. That basically fills up that 10% bracket. Now, if you run your numbers and you say, hey, the 12% is actually going to fit our plan a little bit better, then the conversion amount is going to go up significantly. The amount that you could convert, still, assuming the $48,000 from Social Security is enough, is going to be $86,150. At this point, 85% of that Social Security benefit is going to be subject to taxes, the $40,800 that you see here. Your adjusted gross income is going to be $126,950. We take away the $30,000 for standard deduction. Our taxable income is $96,950, or the very top of that 12% tax bracket. Now, one thing I want you to keep in mind is I would not advocate for you to fill up that tax bracket completely, because in a lot of cases, there are going to be some incidental tax events that occur, and it could throw some of your income over into that 22% bracket. But if we follow this plan and fill up that 12% tax bracket, then this individual, if they had $1 million in a pre-tax account, they could theoretically empty that account in approximately 10 years. And by doing this, they avoid those RMDs and they avoid those taxes that their beneficiaries are going to have to pay once they pass away. So, since we are talking about taxable income in retirement, there are two situations that you do need to be aware of when it comes to doing these Roth conversions. Because you're doing the conversion and you're increasing your adjusted gross income and that taxable income, it could start to affect other things. If you are doing Roth conversions and you are under the age of 65, meaning you're not on Medicare, then in a lot of cases, you're going to be on an exchange plan or an Obamacare plan. The premiums you pay for your health insurance on Obamacare is directly impacted by the amount of adjusted gross income you earn. Before you jump in to doing Roth conversions, you need to know how that change in adjusted gross income is going to affect the amount you pay for your health insurance premiums. Sure, you could save a bunch of taxes and that's great, but if it puts you in a position that you're paying $1,200 per month per person for your Obamacare plan, then how much benefit are you actually receiving? So when it comes to these Roth conversions, you need to be aware of how that's going to affect your health insurance if you're under the age of 65. Now, once you reach 65 and you're on Medicare, the second thing you need to be aware of is IRMA surcharges. And what this is if your income goes over a certain threshold in the past 2 years, then you're going to pay more for your Part B and Part D Medicare. In 2025, if you're married filing jointly and your income is over $212,000, then you're going to start paying more for Medicare's Part B and D. Now, if you're only converting at the 10% or the 12% tax brackets, then IRMA may not be a problem. But once you go on to the 22% bracket or higher, then IRMA definitely begins to play a factor in your Roth conversion decisions. With the Roth conversion, there are a lot of moving pieces. There are a lot of things that you have to take into account to make sure that the Roth conversion is being done in a way that's going to benefit you the most. Not only do you have to worry about what tax bracket you want to fill, you also have to worry about how it's going to affect your premiums for your health insurance, whether you're on Medicare or not. You also have to take into account your specific situation. If you're receiving some tax-exempt interest and maybe some dividends and capital gains from a taxable account, then your tax bill and the calculations that go with the Roth conversion are going to be much more difficult than the examples that we went over. But if you're in a situation where all you have is a pre-tax account and some Social Security income, then the examples we went over are going to be fairly accurate. Again, don't take this video as tax advice. You need to run your scenario by your accountant and by your financial advisor to make sure that the Roth conversion and the amount that you actually do convert are going to be the most advantageous for you. I want to thank you so much for tuning in. If this video or any of the other videos that I put out has provided you value, then hit that subscribe button. If you're looking for that video on the 65-year-old couple and the $1 million in the pre-tax account and all the money that we saved by doing the conversions, then check out this video right here. But I thank you so much for tuning in. I'll talk to you soon.